Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah, and the Talking Point today. Today and tomorrow, we are going to be talking about the earnings season gone by and what are the key standout features that came about in this earnings season. So today, we're talking to Motilal Oswal. Tomorrow, we're talking to Citi. And as is the norm almost every quarter, we love talking to Gautam Duggad on what he and his team made of the earnings season, and what were the key upgrades and downgrades that came about as a result of the 1Q release. Gautam, great having you. Thanks for joining in.
Thanks, Niraj. Good morning.
Very good morning. The pleasure is ours, Gautam. So what do you make of the earnings season? I read the key headline on your note, which seemed to suggest that this was the first quarter after many when we've had earnings disappointments or downgrades, so to say.
Niraj, see, look at it. You have to look at this quarter's earnings slightly differently. If you look at it from the lens of aggregates, there is some clear disappointment because some of the heavyweights like Reliance, Tata Motors, and those OMCs which posted big losses, they actually made a big impact on aggregates. So if I were to put the numbers first, we saw 12% earnings growth in Motilal coverage versus expectation of 20%. And for Nifty, we saw 23% growth versus expectation of 31%. But if you look at the spread and quality of earnings, it is far better. So 70% of my coverage universe actually has met or beaten expectations, right? 14 out of the 20 sectors that we cover have either met or beaten expectations. So 2 or 4, 5 companies, they have actually made the aggregates look worse than what the underlying trend seems to suggest. So therefore, if you were to, for example, if you were to look at Nifty only profitable companies, that is 48 companies, you remove BPCL and Tata Motors, the growth is 31% in earnings versus expectation of 34%, right? If you were to look at just a non-commodity earnings, which is you remove metals and oil and gas, then the growth is 35% versus expectation of 40%. So what happened is the aggregates get disproportionately swayed by some of these global cyclicals. So BPCL posted loss, HPCL posted a big loss, and Tata Motors also posted a big loss, right? So this is on the positive side. If you were to, if I were to find some problems in the earnings, I will say, if you exclude financials, there is no growth. For my coverage universe, if I remove financials, there is no growth virtually. For Nifty, if I remove financials, the growth is 18%. But bit underwhelming versus expectation of 28%. So the way you slice and dice the earnings will make you look at the picture slightly differently. But just to reiterate, the quality of earnings, spread of earnings, internals of the earnings were far better than what just the aggregates give you the picture. So therefore, I'm not that disappointed from the quarterly earnings season. If you get aggregates good and it's get driven by just few companies, then you get a very different sense. You believe that earnings have been good, but it comes from very few sectors and few companies, which is what we used to see in 2015 to 17 era.
Cool. Gautam, so what led to this beating of estimates by a bunch of companies? I mean, was it that you guys estimated that the earnings pressure would be very high because of commodity cost pressures and it was not the case? Or was there some pricing power? Was there some revenue growth which led to operating leverage in some fashion? What led to this beat?
So basically, Niraj, if you look at the overall picture, one of the important points of this earnings season was financials. And financials, what happened, basically your credit cost has undershot once again, right? That is one point. Second, in metals, we estimated a slightly higher damage to earnings than what the actual numbers came. Okay. So while metals earnings have declined, but the decline is less than what we had estimated. Second, if you see sectors like cement, specialty chemicals, the margin decline was slightly lesser than what we had estimated. Cement still reported an earnings decline. For example, if I look at the cement universe, the earnings declined at 13%, but our expectation was a 20% decline. Similarly, for metals, we estimated a 20% earnings decline, but actual earnings decline was 11%. Right? A small sector, specialty chemicals, we estimated a flat quarterly earnings. There was a 17% earnings growth because 2 or 3 companies, their margins surprised big time. right? Consumer was a fairly steady sector, both staples and discretionary. In fact, discretionary demand has, has come out pretty strong. So consumer earnings, if you look at just the staple part of the universe, we saw 35% earnings growth. Expectation was 30%. But discretionary pack, within that, which is Asian Paint, Pidilite, Page, Titan, the entire QSR segment, they surprised big time on both volumes and margins. So it's a mix and match of various sectors, Neeraj. And on the disappointing side, you had healthcare, which reported third consecutive quarter of earnings decline. Earnings have actually declined 17% for the quarter. And of course, as I pointed out right in the beginning, one of the biggest drag was oil and gas. So we were expecting about a 16, 17% kind of an earnings growth. Actual number was a 20% decline. Right. So whichever way you look at it, ex-OMCs, including OMCs, oil and gas was a disappointment in terms of the quarterly performance. And that's all then aggregate into the final picture, that 70% of the universe actually has seen either a meeting of expectations or beating of expectations. If I were to go one level further, if you look at just the profit after tax, which is the final earnings, out of our coverage companies of 215 companies, 100 have been above estimates, 47 has been in line with estimates, and 68 has been below estimate. So that's how we reach that number of 70%, which is 100 plus 47 out of 215.
Got it. When I looked at the list of upgrades that have been done, Gautam, a bunch of commodity names out there, aside of UPL, probably all commodity names. So is it that you found something in the commentary which enthused you for the metal names and Coal India, or what was it?
So in metals, for example, before I talk about sector, if you look at just the aggregate numbers for Nifty, right, for FY23, we have seen a 2.7% earnings cut. So our EPS stands revised from 865, which was the number at the time of preview in July, to about 843 rupees now. So that's a 2.7% cut. But entire cut has happened because of oil and gas. If I were to give you a picture in terms of absolute profits, our estimate of FY23 Nifty profits was 6.95 lakh crores in preview. Now it is 6.68 lakh crores. So we have taken a cut of 27,000 crores in profit during the quarter. And 30,000 crores of profit cut has come from just Reliance plus ONGC plus BPCL. So that gives you a picture that in 50 companies, 3 have driven the entire cut. Rest 47 put together have not seen much of a change. Sectorally, as I mentioned, metals, we have seen a good upgrade of about 10%, but I won't read much into it because these are very volatile, sectors where numbers keep changing very widely between 2 quarters. So the analysts might have estimated a bigger decline in margins. Actual margins were slightly better. And given that now the petcoke coal prices are slightly down, versus the peak that we have seen, they're actually down significantly from the peak in April, May. So you might see some benefit accruing in 2H FY23 there, but at the same time, the steel prices have also come down. So there will be an interplay between the raw material prices and the final commodity realization that you get. Amongst the other sectors where we have seen a semblance of an earnings upgrade, not much was consumer, about 2 to 3% upgrade. We have seen cement earnings staying flattish, no revision there. Specialty chemicals has seen minor upgrade. And then, of course, you have seen big cuts in oil and gas, 20% earnings cut there. Yeah. Tech has seen 2-3% cut. So, and of course, auto, I forgot to mention, because of Tata Motors at an aggregate level, you see about 6-7% earnings cut in auto. So that is how you reach a cumulative earnings cut number of about 3% for Nifty, or rather 2.7% for Nifty, and about 4% for Motilal Oswal coverage universe.
Got it. Yeah, viewers, the top earnings downgrades as per Gautam and his team are BPCL, which is a sharp one, Tata Motors, ONGC, Apollo Hospitals, I believe, and Shree Cement, which has had a downgrade of about 15%. Now, Gautam, now I request you to marry the two. And let's start with the positives. Where is it that you believe the earnings upgrades made a case and valuations still might be comforting? I'm not saying their valuations are cheap at these levels, but valuations might be comforting.
So one of the obvious sectors which come to mind is financials, and we have talked about it every now and then. It's one of the few mainstream sectors where valuations are still offering you a sense of comfort. And the delivery on earnings has been phenomenal, not just this quarter or this year, for last 4 years now. I kept repeating, in FY18, the Nifty BFSI profits were 45,000 crores. We did 1.5 lakh crore in FY22, and our estimate is 1.9 lakh crores in FY23. And that 1.9 lakh crore number has not seen even a percent of a downgrade this quarter, right? So financials is really firing all guns blazing, and now you're seeing credit growth pick up. You will also see transmission of the rate hikes happening in the second and third quarter. So there will be some support to NIM. And third, and the most important, is your bond yields are down to 7.2%. So the write backs can happen on the MTM, the treasury portfolio. This is what hurt them on the operating profit side this quarter, because a lot of banks took a big knock. SBI took a 6,500 crores of write down in MTM treasury book. So these three factors is credit growth, NIM, and treasury write back can again help them in the next 2 or 3 quarters. And valuations are still very reasonable for the large cap financials across NBFC, across banks. You saw the commentary of Bajaj Finance, their numbers actually on AUM, the guidance ahead, and the kind of profit growth that people are estimating. So financials seems to be a very interesting sector to look at, given the delivery on earnings. And we have seen 2 years of COVID has also not impacted the balance sheets at all. PCR of most of these banks is upwards of 80%. Tier 1 capitalization of 15 to 17%. So they are very well placed. And I think if credit growth picks up from here also, they are set to benefit big time. So that is one sector where clearly valuations also look in their favor. And then you have sectors like auto, which is making a comeback after a long, long time, after almost 4 to 5 years of a downturn. After 14 consecutive quarters of downgrades, we have not seen a downgrade during the time of preview. In review, we have, of course, seen because Tata Motors has swayed the numbers big time. But otherwise, the underlying fundamentals of auto on demand, on supply, the issue on semiconductor seems to be resolving itself, and commodity costs have come down. And people are already talking about festive season for auto companies this quarter, or this October to November period, should exceed the 2019 numbers finally. We've already seen the Independence Day weekend for retail companies, e-commerce companies coming quite well. So that is one sector where cycle seems to be in their favor now. Some of the stocks are already reflecting that buoyancy. You've seen iShares crossing the 5-year-old high finally, right? You've seen M&M doing very well this year, one of the best performing stocks in the Nifty. Maruti and two-wheeler, obviously, some of the two-wheeler names are still not anywhere close to their earlier highs. But if numbers are anything to go by, I think they are set for good time. And then, of course, consumer discretionary also coming back in. So suddenly the conversation, which was dominated by value for large part of 2021 and early part of 2022, and for right reasons, because rates were going up, liquidity was shrinking. Now, growth making a comeback and yields having moderated, again making a case for growth stocks to come back in vogue, and which is where we are seeing performances of Bajaj Finance, Page, Pidilite, Titan, again, surging.
Yeah. We've spoken about the likes of Titan and others ad nauseum, so I won't get into that conversation again. But viewers, trust me, if you want to get a lowdown on what the business metrics around a Titan or some of the other consumer names should be, watch the same conversation that we had last quarter with Gautam Duggad. Gautam, one quick follow-up on companies wherein the earnings disappointments and rich valuations leave room for downside in an otherwise buoyant market.
Yeah. So I think some of these sectors, Niraj, like specialty chemicals, where expectations are very elevated, right? Given variety of macro factors which are in favor of them, China +1, the big capex that they have done. But, the prices have run up ahead of the fundamentals. So there can be some cool off that can happen in that space, I believe. But, it's very...
Even earnings could be an issue.
Earnings can be an issue because they are standing on a very high base, but earnings can fluctuate a lot, as we have discovered in the last 3 quarters. They have so far surprised on last 2 quarters, where we were expecting margins to take a big knockdown, but at an aggregate level, they've done well. Like I mentioned, they reported a 17% profit growth this quarter. We were expecting the quarter to be flattish, but valuations are a bit rich there. And any downside surprise can, have a disproportionate impact on the stock. So because the expectations are very elevated there. then by and large, I don't think other sectors are trading at an obnoxiously expensive valuations.
Okay.
Consumer has always traded at a rich valuation, so no difference there. They always trade rich for a variety of reasons. Then you have, so if you look at index itself, Niraj, Nifty at about 18 times, 18.5 times. Look at FY24, 1,000 rupee EPS. If you look at FY23, it is somewhere about 20, 21 times. So it is not cheap, but at the same time, it is not very expensive either, I would say. It's in a fair value zone. So the expectations on near-term returns have to be very moderate now. Unless something happens globally on the commodity side, or your yields come up significantly and lend extra support to the equity valuations. But mid-cap is still trading at an expensive valuation. If you look at the NSE mid-cap 100 index, it's trading at somewhere about 21p, so which is at a 10 to 15% premium to Nifty. What has gone into discount in the last 1 year is NSE small cap. So this was trading at a 20% premium a year and a half back when small cap stocks were rallying. Now at 15 times, so it is at a discount to Nifty. And small cap, in fact, if you take a step back and even evaluate the performance of the small cap index versus the previous cyclical peak of December 2017, then for 5 years almost, it has done nothing, right? So you can obviously look at different starting points and make a case. So for March 20, you would say it's up 3x. But from December 17 to December 22 almost, 5 years is given very flattish kind of performance. So it depends where you stand and which index you look at. Valuations obviously are never an absolute game.
No, but which is why talking to you is so lovely. So many nuggets come out. Gautam, what within small caps universe, which themes, which specific pockets, which earnings surprise you? And then at the end, I'll do a bit of a quick conversation, rapid fire with you. But before that, my final question on small caps, what themes stand out?
So I think, Niraj, again, the same sectors. You look at some of these auto names, auto hangs, BFSI, smaller and mid cap, has been absolutely, underperforming for a long period of time. Right? Generally, they are very cyclical. Large. If you look at a wealth creation in financials over the last 2 decades, bulk of it is driven by the large caps only. Yeah. Very few small cap financials have been able to create wealth for a sustained period of time. Right, but if the theme for financials continues to do well, then obviously some of these mid-cap, small-cap financials on banks and NBFC side, and even non-lending financials, they will make a comeback.
So what within your coverage universe do you believe you have conviction? Yeah. Whatever you can say, Gautam.
So our preferred ideas on the mid-cap, small-cap financials have been names like Angel, names like ICICI Securities. On the lending side, we like AU. Right, and then on the NBFC side, we've taken a cyclical punt on M&M Finance and had added it in the model portfolio recently. Okay. So those are some of the small cap, mid cap financial names we like. Consumer again, mid cap pack, which basically comprises mostly of this QSR names. We are very hot on that theme for last more than 2 years. So our preference has obviously been Jubilant Foodworks, but some of the other names aside of Jubilant that we like are Devyani, Sapphire, and they have had a very strong and solid quarter, whether it is in terms of their same-store growth or their commentary, network expansion, all of that. What we right now are not liking much is healthcare, because the earnings support is not there. And this is a very bottoms-up sector. We saw 1 year of a spike during FY21 when earnings went up 40-50% at an aggregate sector level. But now it is back to that period where 8-10% growth seems to be the norm. FY15 to 20, healthcare earnings went nowhere. 21, there was a sudden spike because of COVID when they benefited, 50% profit growth. 22 normalized to 15%. And 23, the expectation is now back to 10-11%. So that is a space where we are finding it a bit difficult, while valuations obviously support because of the underperformance. But the growth element seems to be lacking. And then amongst the mid-cap, small-caps, as I mentioned, with growth making a comeback, some of these stocks which people always liked but found the valuations expensive, names like Page and all, the whole ceramic space, some of the other retail names like ABFRL, Trend, they can benefit big time because we are now entering an era where festive season will begin. And next 3 to 4 months will be dominated by conversations around festive season. So if festive season does well, you also have a short-term catalyst for some of these segments. You're on mute, Niraj.
My final question, and I'm wanting to understand from you. We can make this a very quick conversation, but 2 or 3 names, if you have them within your coverage, and if you have a view on what their earnings or the halo effect on them could be. I believe some of them you do have. So, you spoke about how rank outperformer Mahindra and Mahindra has been, right? Does this EV halo effect stay on M&M and kind of give it buoyancy, earnings buoyancy, as well as the sentiment buoyancy, you think?
I think it is quite possible, Niraj. And look at it this way: after all the rally it has had, it is still trading at 15 times, right? So, the margin of safety is very high there. Of course, it's a slight bit of cyclicality which is inherent given the tractor business, but I think they're getting the product life cycle right. Some of their products have been blockbusters. And if tractor industry starts doing a little bit better than what it is for now, then you still have room for upside there. Right. So despite the rally of 40-50% that you have seen in CY22 so far, your valuations are still in your favor.
Got it. Is a small cap or a mid cap specialty chemical stock, which I believe you have in your portfolio, wherein the earnings surprise Gautam, fine organics. I mean, there was a blockbuster reaction to that too. And it is probably not a very cheap stock either, but the earnings were rock solid. What do you make of the numbers?
Yeah, I mean, the numbers were blowout. 2 years back, they were reporting profits in the range of 30-40 crores for the quarter. This quarter, I think they reported about 150, 160 crores. So that's what I said when I spoke about specialty chemicals. It's very difficult to get a handle on their quarterly numbers because the margins fluctuate a whole lot. And then that flows through to the bottom line. But the execution has been phenomenal. The other name which we like in that space is Clean Science. Very small, again, recent listing. But next 2 years, our estimate seems to suggest that the profits are going to double. And the ROE is upwards of 30%.
And you might be conservative.
Possible. These things change very rapidly depending on where the input costs go. But more importantly, they are in a category and segment which is very niche, right? So therefore, the threat of competition is quite limited in that segment for where they are. So specialty chemicals has been a star performer last 3-4 years, and the journey has just begun because their sizes are still very low.
Got it. My final question, and we've spoken about consumption a number of times. I wanted to understand if you do have thoughts on PVR or Inox or the PVR Inox combined, because here's a monopoly, so to say, but we do see near term Bollywood kind of faltering a little bit. The last few releases haven't been great. And who knows the sentiment around that, therefore? Yeah,
actually, you're right. And it's an interesting, proposition to evaluate. The two big daddies of that sector combining, gaining scale and consolidation. Maybe it will help them price their product slightly better. But see, Niraj, just to counter that point on Bollywood, while Bollywood has faltered for a variety of reasons, you've seen South making a big dent. Right, and the consumption of South-based blockbuster films has gone up big time, whether it is on multiplexes or on OTT platform. So like it or not, PVR is the only name available in that space today. So if you have to play that opportunity, it's not as if you're juggling between multiple choices like in other sectors like banks, IT, or consumption. Here, if you have to bet on it, that's the only worthwhile play which is available today.
Got it. Gautam, always great talking to you. Today was no different. Thank you so much for taking the time out and speaking to us today. And viewers, thanks for tuning into this conversation of The Talking Point.